Welcome back. Markets are mixed this morning. Let's take a look at futures, indicating a mixed opening this morning after a tech-led retreat yesterday. Dow Industrials this morning are up 37, but the S&P is down half a point, and the Nasdaq lower by 17.5. Yesterday, the Dow lost better than 300 points at its worst. Stocks closed at their lowest since November 9th. The Dow Industrials ended down 162 when all was said and done, about 0.5%. The Nasdaq was down 160. Joining me right now is Laffer, Tengler Investment CEO and Chief Investment Officer, Nancy Tengler. Nancy, great to see you this morning. Thanks so much for being here. What kind of a market are you expecting in 2023? And what do you do if we do have a year-end rally in this last 2 weeks of the year?
Oh, let's hope, Maria. Thanks so much for having me. And just for the record, on the ground in Arizona, the border's wide open.
Yeah, exactly.
In terms of the market,
thank you for that.
The volatility has been, pretty breathtaking this year, and we expect that to continue into Q1. But I will say that I think one of the things that investors need to start thinking about is what can go right in 2023. The Fed has been behind the curve all the way through, and yet we continue to quote them, with certainty that they're going to continue to raise rates. But let's remember that the dot plot in September of 2021 indicated they weren't going to even get to 2% until 2024 at the Fed funds rate. So I think what the market has been battling with is that many of us seem to think that inflation has begun to roll over. It peaked in June. And though we're going to see weakness in earnings, stocks actually bottomed in 1982, months before it started to rally, months before Volcker actually changed policy and then erased all of the losses in a few months. So there's a lot that can go right going into the next year, even when earnings are depressed.
Well, we might have seen the worst on inflation, but have we seen the worst on economic growth? We've got the final read on third quarter GDP out this week, November's personal consumption expenditures index also out this week on Friday, Nancy, and there are so many expectations that we are in recession in the first half of the new year. So what's your take on the macro story?
Yeah, I think we're definitely slowing, and when we go into a recession is just a question of time and the NBER where they declare it. But we know we're slowing, and so we've been positioning our portfolios for stocks that will do well in a slowing growth environment. So take a name like Steel Dynamics. It's an early cyclical. It's got a yield about 1.2%, but they've been raising it 16% per year. And this is a company that's embraced digital in the production of steel, and also they've cornered the market on recycling, so they can control their input costs. So we like those kinds of names. A Broadcom that yields 3.5% has really controlled the backlog. And so they know that their orders are real orders, and they pay 3.5%, and they've grown it almost 30% a year over the last 5 years. So we're looking at names like that. I know everyone's excited about dividend payers. I've been managing dividend growth strategies since 1984. So this is not a fad for us. This is in our DNA and what we do.
Yeah, that's great analysis. Let's bring Mark Tepper in. Go ahead, Mark.
Good morning, Nancy. Look, I agree with you. I think dividend payers are probably where you want to be right now, especially for those investors who are looking to buy the dip. But a question for you, there's a lot of investors who are just itching to get back into some of their favorite growth stocks. What do you make of the opportunity for growth stocks in 2023?
Boy, Mark, it's 4 a.m. here. That's a good question. Good to see you. So we actually have a growth at a reasonable price strategy. I think when you're playing in the growth space in this coming year, you need to be very disciplined about when you enter and what you're buying, obviously. So the companies that have no earnings, we're not interested in those. Interestingly enough, Tesla just came into our buy range on a relative price to sales ratio basis. The company does have earnings now, and we're taking a close look at it. If we added to a name like that, we would ease in over the first quarter, because I don't think you're going to get a growth rally until the second half of next year, or maybe summertime. So reason for that is I think we need to see a pause in policy from the Fed or an actual pivot, which I don't expect to see until the second half of the year.
Yeah,
so I think you want to be cautious.
It's a great question, Nancy, because of some of these declines. I mean, you look at a stock like Amazon, down 50% this year. All of the major big-name techs are down, but, they could go lower. So we'll see how that first half really trades in terms of markets responding to a weakening economic backdrop, especially with advertising where it is as well.
Right. That's right. And I think you have to worry about that with Google and clearly with Meta, which we've been out of for over a year. It's treacherous waters, but at some point you're going to want to get back into those names.
Nancy, it's great to see you this morning. Thanks so much.
Thank you.